Hello and welcome to this short screencast on the new Seed Enterprise Investment Scheme. My name is Steve Livingston. I'm a chartered accountant and tax advisor, and I specialise in advising fast growth entrepreneurial companies. I also blog at businessn2k.com. This is a short canter through the key issues. It's really an awareness piece in terms of the new Seed Enterprise Investment Scheme. Throughout this, I will refer to the Seed Enterprise Investment Scheme as SEIS, or sometimes SEIS for short, which is the acronym for the letters in the full name. So this scheme was introduced from 6th of April 2012, and it is fairly new. So what is it? Well, the Seed Enterprise Investment Scheme is a highly tax-efficient way for early-stage companies to access funding. And the question is, at a time when bank funding is tight, can you afford not to be aware of this tax incentive? I must confess that in practice I'm finding that a lot of companies, disappointingly, are not aware of this. And it is really aimed at early-stage companies at seed capital level, so it would be much more favourable, obviously, if companies were aware of this. Although I am finding that certainly private investors seem to have a greater awareness of this new tax incentive. So what's so good about SEIS? Well, the headline is really the income tax relief for the investor. 50% income tax relief, regardless of the marginal rates paid by that particular investor. So even if they suffer tax at 40%, they still get this 50% income tax relief. So £100,000 invested, HMRC will repay £50,000 of the tax they've suffered. So very, very attractive. The second key thing is there's no capital gains tax on disposal. So after the qualifying 3-year period, no matter how successful that investment might be, that size company, the investor will pay no capital gains tax on disposal. And finally, quite interestingly, there is a sweetener of this capital gains tax exemption on any gains incurred in the tax year, this first year of the SEIS being implemented, being the tax year 6th of April 2012 to 5th of April 2013. So if an investor crystallises a gain, and that can be a gain on, for example, a second property, a rental property, or it could be on a share portfolio, which isn't protected by a tax wrapper such as an ISA or a pension. If they were to realise a gain in this current tax year we're in now, up to 5th of April 2013, they would normally pay tax at 28% if they're a high rate taxpayer. What they can choose to do instead is to invest the gain into a SEIS investment, and that gain will be wiped out completely. Not a deferral, a complete exemption. So that results in potential jaw-dropping 78% tax relief for the investor. So a 22% in the pound actual cost for the investor. So how much cash can we raise under CDIS? Well, the company is limited to £150,000 in total, not per year, in total. What it could choose to do is look for funds after it's expended most of that cash, being 70%, at least 70% of that cash. They can look to raise funds under the bigger brother of CDIS, which is the Enterprise Investment Scheme, or EIS for short. A point to note is you can't do it the other way around. The company can't raise funds under EIS and then raise funds under SEIS. It has to be SEIS and then EIS. The investor can invest up to £100,000 per tax year. So that's year on year. As the legislation stands, SEIS will be around until 2015, so we have about 5 years as it currently stands for investors to reinvest under this scheme. So what are the drawbacks or limitations? Well, the company must be a trading company. There's a carve-out for certain non-trading companies in the Revenue's view, and there's a prescriptive list, such as like property investment companies. The company can't be more than 2 years old, which makes sense being that it's for seed capital. The company can't have more than 25 employees at the time of investment, and it can't have more than £200,000 of gross assets, and that's before the CDIS cash goes in. The qualifying SEIS trade must carry on for 3 years or more, a minimum of 3 years. And this is a point to watch. I certainly find this in practice, that it's all very well getting your ducks in order and making sure that you've got the SEIS set up on the way in, but what you must then do is ensure that you remain a qualifying SEIS company for the full 3-year period. I've found, certainly in practice, that companies are toddling along and they make it to year 3, they're almost there, and they're about to do something which could jeopardise the relief. So the investors could lose the tax relief they've received on the way in, and you can imagine how disgruntled they would be if you ended up doing that. The investors must subscribe for ordinary full risk shares. That's exactly as it is under EIS. It's, again, a bit of a shame. There was a suggestion they may relax this and allow loans, but no, it must be full risk ordinary shares. And to prevent connection, the investors must hold less than 30% of the shares. There are restrictions around employees qualifying under SEIS, although directors can. There are a whole host of other small traps for the unwary, which is a real shame, because we were hoping that, given this is aimed at startup companies, there'd be more relaxation in terms of the application of this particular incentive, but they have ended up following pretty much the EIS rules, which have some oddities in there which can come and bite if you haven't done this sort of thing before. So what next? Well, if you're a company and you are now thinking, hey, I would like to qualify for CDIS and raise funds under this, well, you'd be well advised to get advance assurance on your qualifying status from HM Revenue and Customs. And that's the process of applying to them and getting back from them, if they're satisfied with your application, a piece of paper which will say, yes, you are, in our view, a qualifying company. Many more sophisticated private investors would insist on you having this before they will part with their hard-earned cash, because they then will have the degree of assurance that they will get their personal tax relief. You could also sign up to our mailing list at seedeis.co.uk. It's a specific site we've set up, specifically targeted obviously at CDIS. What we've done there is we've also uploaded some further, more advanced SEIS tax planning strategies, some screencasts there which you can watch, which may give you some further ideas as to how this tax incentive can be used. You have to be on the mailing list to get access to those, so I urge you to do so. And also we'll be looking at, if you are, again, a company looking to raise funds into SEIS, and you're trying to find some private individuals who may be willing to invest, and likewise if you're a private investor, a business angel looking for some more opportunities, again, get on our mailing list and we'll see what we can do there in terms of providing some updates and perhaps doing a bit of matchmaking there. So please get on over to cdis.co.uk and say mailing list, get on there, and you'll get access to all of that. So that really sums up the short screencast on CDIS. If you want to get in touch with me, I'm on businesssenseuk.com. If you would like to drop me a line, I can come back to you if you have some specific questions around CDIS. Again, it's always best to seek professional advice on these matters. If you would like to speak to myself, and I deal with quite a few of these sorts of things, more than willing to help if I can. If you would also like to join our mailing list, you will get more business insights and updates, so I would urge you to do so. My name's Steve Livingston. Thanks for watching.